Hey everyone, how's it going? Welcome back to Lunch at the Market. We have had a ton of questions from some of our followers on Twitter today regarding what to do and how to use a put butterfly. Tons and tons of questions from @PNavarro88 and @Venom56. So here you go, guys. Rather than just going back and forth, the easiest thing to do is just really to show you how it works. Okay, a put butterfly. We use a put butterfly when we've sold put spreads short and they're really going against us, and it looks like we may need to take the other side of the trade. The problem with just simply switching to selling call spreads is twofold. Think about switching to selling call spreads in something like F5. You would be now getting your face ripped off after getting your face ripped off by selling put spreads, and so you'd end up just being a terrible loser on the trade. We're opposed to losing money because that's what we do for a living, is make it for people. And so it's just not that easy to switch to selling call spreads, because eventually, if you've done your homework, the stock is going to turn around and go back up. And so the fact that you're down on your put spreads means that you are bad at timing, not that you're bad at stock picking. So take a name like CREE, in which we've been endlessly wrong, and we've sold put spreads, and we've been wrong lots of times over the last 6 months. So the way to do trade repair is to start making bearish bets. But if you make an outright bearish bet and you're wrong, then you're just going to, again, compound your losing of money. So the great thing about the put butterfly is you'll see the structure. On the left-hand side, we have your strike prices: 42.5, 37.5, 32.5. Those are the three strikes. You see the word put in the middle of each line to indicate that this structure is made up solely of puts. On the right-hand side, you see the amount that you need to complete the structure. 1 at 42.5, 2 at 37.5, and 1 more at 32.5. So essentially, you are both long a put spread and short a put spread, using the middle strike of the butterfly as your pivot point. Now, in this case, 42.5 that put is already in the money. You see right there on the board, we wrote the approximate the price where the stock trades at $39.02. This trade is already in the money by $2.50. So that's intrinsically what this structure is worth right now, right? 42.5 is where you're long a put. The stock trades at 39. You subtract the 2, and you're going to get basically $3.50. $3.50. We only paid $1.58 for this structure. $1.58. If the stock expires right now at $39.02, we're going to make roughly $3.48 is what the structure will be worth at expiration. And we only paid $1.58 for it, so you're going to get around a $2 gain. Now, what we have done when CREE has gone through the strike that's the middle of the butterfly, which in this case is 37.5. We roll the top strike, the 42.5. We're going to sell those. So Deacon's going to yep, he's going to erase that put. Boom. That put is now gone. What's interesting about this trade is you see that your profit is still above 37.5. You have full profits above 37.5. So that green area indicating your profits, we're going to leave that there. Then what we're going to do is change the number on the put on the bottom strike. So we sold the 42.5 and bought the 32.5. You will get paid for this transaction. You will get paid for this transaction. In the case where we just did this on our previous put butterflies for May, we got paid $5.60 to roll from the top strike down to the bottom strike. $5.60. In our previous put butterfly, we only paid 60 cents just to put the trade on. So when we rolled down, we took in $5.60. We paid for the 60 cents it cost just to put on the trade. Now we've taken in $5. Now, that $5 represents the entire width of that bottom short put spread. You see how now the only thing we have is short 37.5 puts and then long the 32.5 puts. And that is a short put spread. The whole width of that is $5. We could take a complete loss on those short put spreads and we would break even on the butterfly. We could take a complete loss and still break even on the butterfly. Ideally, what will happen is the stock will finish it'll finish above 37.5. We'll get to keep the full $5.60 that we got paid. 60 cents of that will go to pay for the whole structure that we paid to put on to start the whole trade out, and we will net $5 for a $5 wide spread. We're going to net $5. Normally, we're happy if we take in $1 for a $5 wide spread. Here's how this trade works. Even if CREE, say it goes to $35, there's still $2.50 between 35 and 32.5. We got paid $5 to roll down, and so our profit will be $2.50. Again, more than double what we usually expect to get for selling a $5 wide spread. So what's great about this put butterfly is you can adjust it, you can adjust the trade to basically get yourself in a position where you're going to win no matter what. The only way that you quote-unquote lose in this is if the stock trades above the top strike on your put butterfly, and then basically you lose the $1.58 that you spent to put it on. Again, we are using these as a hedge, meaning we're already short put spreads further out on the calendar, and so if the stock moves up, we will gain more on our short put spreads than we will lose on our put butterfly. The other thing, take for instance F5. F5 reported earnings, we were long a put butterfly, and all we did was the standard trade repair. We sold the top strike, rolled it down to the bottom strike. We got paid $1.05. $1.05 to do that, which now means that we're essentially short a put spread in F5 at the 90.85 strike price for most of the butterflies. Some of the butterflies were even lower, and so we ended up with a short 85.80 put spread. Bottom line, you just sit around, twiddle your thumbs until the calendar comes up and the expiration is up, and then you're just left with a normal short put spread trade. The stock finishes above the strike where you're short, and you get to keep the money. Okay, on the F5s, I think we spent maybe 80 cents to put on the butterfly. We got paid $1.05 to roll down. We're going to net 25 cents or so on the trade. Okay, that's how the put butterfly works. It's used as a hedge. If you can do it in the money, like in this instance, we started out being long the 42.5, short 2 of the 37.5, and short 1 of the 32.5s. We started with the trade already in the money. And so we don't really need the stock to do anything, and we were profitable on this trade. If the stock trades down to 37.5, then we sell the top strike, use the money to buy the bottom strike, turn it into a short put spread, and you're good to go. So that's how we use the put butterfly over here at Magnum Opus Financial. We like to buy them in the out months, so that way we have some time, and we have tons of strikes that we're working with, because keep in mind a lot of times we're also short a put spread or somewhere in the next month. So this is for June. We've got put spreads that we're short in July. That's how we use the put butterfly, and that's how we adjust the trade. Thanks for joining us on Lunch at the Market. Don't forget to check out America's Favorite Traders. We just saw Dan Fitzpatrick on Power Lunch today. You can catch Dan for an hour on America's Favorite Traders by going to magnumopusfinancial.com, clicking on the America's Favorite Traders button, which is the big red button that's in the middle of your screen on the left. You get all kinds of interviews: John Najarian, Dan Fitzpatrick, James Altucher, Zachary Carabell, Jared Levy. All of those guys have been on for season 2. It's an unbelievable show. Don't forget, if you go to iTunes and search for America's Favorite Traders, you can download them all for free. And if you live in North Carolina, go to mofoptions.com. That's MOF for Magnum Opus Financial, mofoptions.com, and register for the class. It's going to be a 10-week class in Winston-Salem for a great price. Thanks for joining us again today on Lunch at the Market. Have a great day, and we will see you tomorrow. We'll see you Monday because it's a holiday weekend. See you on Monday.